Hey, this is Chris, and in this video I'm going to be sharing my thoughts on the all-weather portfolio. Now, the idea of an all-weather portfolio actually stems from a famous portfolio, the risk parity all-weather portfolio, which was invented and managed by Bridgewater Associates, the biggest hedge fund in the world, which is famously managed by Ray Dalio. This concept has been sort of taken and used by people managing their own portfolios who have now used this similar approach to build their own all-weather portfolio strategies using ETFs or other low-cost ways of accessing asset classes. Now, Dalio's all-weather theory basically stems around there being a few different things that affect markets over time. So one being inflation, two being deflation, three being rising economic growth, and four being falling economic growth. And Dalio's theory is basically that because these four things affect markets, there ends up being four different seasons of the market. There are the higher than expected inflation season of markets, the lower than expected inflation season of markets, the higher than expected growth season of markets, and then the lower than expected growth season of markets. And the aim of an all-weather portfolio is to be able to withstand these different market scenarios and perform well without large drawdowns or large falls in these four environments, accepting that it's very hard to know which environment you're about to enter and which one is coming up next. Now, ultimately, I think the theory behind an all-weather portfolio is pretty sound because you do want a portfolio that can perform well in different assets, environments, and also make sure that you've got assets in your portfolio that can protect against inflation versus deflation, perform well in a high growth or low growth environment, because these environments are very hard to predict. Now, historically, the all-weather portfolio has an allocation to 30% in US or domestic stocks, 40% in long-term government bonds, 15% in short-term government bonds, 7.5% in commodities to protect against inflation, and 7.5% in gold. Now, this traditional all-weather portfolio is actually quite similar to our stock spot conservative strategy, the Amethyst strategy, with the main differences being that the Amethyst strategy doesn't have much exposure to long-dated government bonds. It's mainly focused in shorter-term government bonds. And also, rather than having a split between inflation protection commodities and gold, all of our 15% allocation is to gold. But with those small nuances in mind, our Amethyst portfolio has actually performed in a similar way that you would expect an all-weather portfolio to, which is that when there are large market falls, like in March 2020, our Amethyst portfolio only participated in around 20 to 25% of the market fall. In other words, it protected against the large majority of the share market fall, and that was due to some of these exposures in government bonds and gold. So for some people who are more conservative, who want to make sure their portfolios can withstand different market environments, I do think an all-weather approach makes sense. However, it's not for everyone, so I would recommend that before you think about using an all-weather approach, consider whether it's right for your investment horizon, because for someone that's investing for 50 years or 30 years, it may not make sense to have such a high allocation to a low risk and generally low returning asset class like government bonds.